Invest like Warren Buffett, goes the conventional investing advice. Find great companies, buy their stocks, and hold on to them forever. Sounds simple, right? Except it's not. And deep down, you probably already know that. You've tried the strategies, read the books, maybe even downloaded the stock picking apps. But somehow, your portfolio doesn't look like it's on track to make you the next Oracle of Omaha. The man's record speaks for him. We cannot debate against it. Buffett's stock picking genius is unquestionable. But what nobody tells you is that the just do what he does advice, it's impossible for the average person to follow it and turn out to be as successful as Buffett. Let me explain. Imagine a game where one player starts on level 1 and another starts with a cheat code that puts them on level 10. They're still playing the same game, but the experience? Entirely different. That's Buffett's story. He's playing on a level most of us will never reach, and it's not just because he's good at the game. It's because of the advantages he had when he started. Warren Buffett didn't stumble into investing blindfolded. He had a head start most of us can't even dream of, a safety net, early exposure, and opportunities that simply aren't available to the average person. And if you're wondering what those are and why they make all the difference, stick around. By the end of this, you'll understand exactly why investing like Buffett isn't as simple as it sounds, and more importantly, what you can do instead. Warren Buffett is more than just a name in finance. He's a legend. With a net worth exceeding $140 billion, he stands as one of the richest men in the world. But what truly sets him apart isn't just his wealth. It's his approach to investing and building wealth over decades. Buffett's journey began humbly in Omaha, Nebraska, where he developed an early fascination with numbers and business. At just 11 years old, he made his first investment, buying shares of a company called Cities Service. That was the start of a journey that would see him transform Berkshire Hathaway from a struggling textile manufacturer into a global conglomerate of immense value. Today, Berkshire Hathaway owns a vast portfolio of companies, including American Express, Coca-Cola, Apple, and more, proving Buffett's ability to spot hidden potential in businesses others overlook. One of the reasons Buffett's story resonates with millions is his simple yet profound investment philosophy. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This wisdom has guided him through market crashes and booms alike, teaching investors to go against the herd and focus on long-term value rather than short-term gains. Buffett's success isn't just about his investment strategies, it's about his mindset. His patience, disciplined approach, and ability to stay calm in the face of volatility have made him a household name. However, while his wisdom and experience are invaluable, they're not always easily replicated. You're now wondering if Warren Buffett's strategy seems so simple: find great companies, hold them forever, and let compounding do the work. Why are you saying I can't just do the same? The truth is, while his principles are sound, there are hidden advantages Buffett has that make his approach incredibly difficult to replicate. Let's start with where Warren Buffett came from. He wasn't just any kid dreaming of wealth. His father, Howard Buffett, was deeply immersed in the financial world as a stockbroker. From a young age, Warren was exposed to stock reports, market insights, and financial conversations, an environment that laid the groundwork for his understanding of investments. By the time he made his first investment at just 11 years old, Buffett already had access to knowledge and tools that most people don't encounter until much later in life, if ever. This early exposure gave him a significant head start, allowing him to grasp complex financial concepts and cultivate a mindset geared towards wealth building at an early age. For most, this kind of early access is rare, and it's one of the many reasons why replicating his journey isn't as straightforward as it seems. But it wasn't just knowledge. Warren Buffett had something far more powerful: security. His family's financial stability gave him a safety net that most people simply don't have. Imagine this. If your first big investment tanks, it could mean losing your life savings or even struggling to pay rent. That risk can be paralyzing for many, making it harder to take bold steps. For Buffett, failure wasn't catastrophic. He had the freedom to experiment, learn, and try again. He could afford to make mistakes because his basic needs were never tied directly to his investment decisions. That level of security gave him the room to develop and refine his investment approach without the constant fear of losing everything. That freedom to fail is a luxury that most people simply don't have. And while knowledge and strategy are important, the safety net Buffett had played a significant role in shaping his success. It allowed him to take calculated risks, learn from his experiences, and build wealth over time. And then there's timing. Warren Buffett started investing in an era when the stock market looked very different. Back then, it wasn't packed with millions of retail investors constantly trading or dominated by lightning fast algorithms scanning every move. It was a quieter, less competitive space, full of inefficiencies that someone with Buffett's deep understanding and patience could easily exploit. Fast forward to today, and the game has changed entirely. With the rise of technology, you can buy stocks with a single tap on your phone. But here's the kicker, so can everyone else. The tools are more accessible than ever before, but with that accessibility comes heightened competition. The average investor today isn't just competing with other people. They're up against algorithms that process information at lightning speeds and hedge funds with billions of dollars in resources. It's a whole new ballgame where the playing field is more crowded and opportunities are harder to come by. Buffett thrived in a time when the market wasn't as saturated, giving him an edge that's nearly impossible to replicate now. Now, here's another factor: Buffett's emotional resilience. He's famous for staying calm when everyone else is panicking. When markets crash, most of us feel fear or anxiety. But Buffett, he sees opportunity. Part of that is his temperament, but part of it comes from the fact that his basic needs, his home, his future, were never tied to his portfolio. Losing money for him didn't mean losing everything. For the average person, it's not that simple. And as Buffett's wealth grew, his advantages compounded. During the 2008 financial crisis, for example, he didn't just buy stocks like you or me. He struck exclusive deals, investing billions in companies like Goldman Sachs, with terms that guaranteed him a 10% annual return, terms no retail investor could ever hope to negotiate. Investing like Warren Buffett may sound appealing, but it's not something that just anyone can jump into. If you're starting from the bottom, there's a more practical path you need to take. Acquire a high-value skill, whether it's in tech, graphic design, marketing, real estate, or even a trade skill like welding or carpentry. Having a skill that provides value can become a powerful tool for building capital. And here's why this is very important. Imagine earning 10% on a $1,000 investment. That's just $100 over a year. Honestly, I don't know about you, but that doesn't exactly excite me. Now, let's scale that up. The same 10% on $100,000 turns into $10,000, and on $300,000, it jumps to $30,000. Now we're talking real money. Now I'm starting to get excited. The larger your base, the more significant those returns become. This is why Charlie Munger once said, "Get your hands on that $100,000. I don't care what you have to do to get it." Back in 1995, that $100,000 would be closer to $300,000 today when adjusted for inflation. So here's the deal. Go get your hands on that $10,000, then aim for $100,000 and eventually work toward $300,000. Only when you've built that capital can we start talking about how you can invest like Buffett. Until then, you're operating with a strategy that doesn't fully apply to your situation.